another study circle meeting focusing on section 20 to section 30 of the Income Tax Act 2025. These sections provide us foundational learning for the practical understanding of the new tax code. So without any further ado, let's welcome Anisha for the further discussion. Let's have a productive learning.
Today we are going to learn section 20 to 30 of new Income Tax Act 2025. As we all know, what is the vision of new Act 2025? First is the simplification, changing all the old sections which were in very vague languages into a simplified and simpler languages and consolidation of chapters. Then is the digital code, having all real-time digital compliances, then faceless assessments, and directly into the bare acts of framework. Then is the global norms, aligning the tax year concept and reporting standards with the international best practices. Moving on to section 20 to 30, first let us all recall what were the previous sections that we have learned in the meeting. That was from section 11 to 19. So anybody can say what was section number 11 we learned in the previous meeting. Exactly. Section 11 was income that does not form part of the total income, from mentioning all income from schedule 2 to schedule 6. Then what was section 12? Income of political parties which does not form part of the total income. That was mentioned under the schedule 8. Section 13. All kinds of the income starting from salary, income from house property, PGBP, monthly gains and IFOs. Section 14. What was section 14?
Doesn't form part of total income, expenditure related to
That also doesn't form part of it. Yes. Section 15.
salaries.
We are starting from the first head of income, that is salaries. Section 16. Income from salaries, what are included in the head of salaries. Section 17. Section 18. Profits and lieu of salary. Section 19. Deductions from salary. What were the deductions from the salary? Special tax, standard deduction is that. That's it. Now moving on from section 20 to section 30. It has been divided into two parts. First one is house property. First part is covering house property income and next is the PGBP income. So starting from section 20, that is basis of charge of house property income. Section 21, here how do we determine the term annual value. Section 22 is of deductions. What are the deductions that are available in the house property head. Section 23 to 25 is of arrears and recovery. Any rental income which we have received in arrears or any unrealized rent which we have earned in this current taxes, how that will be taxed. Then after section 25, section 26 starts with the another head of income, PGBP. First one is the basis of charge. Second is the computation manner. Then section 28 is the section 28 to 30 is of all the various business expenses that we can claim as deduction. Starting with section 20. Priorly it was quoted in section 22 in the previous act. Now first, what is basis of charge mean? Basis of charge is a fundamental rule that says when, how and at which rate an income gets taxed under this head. See now, any income to be taxed under the head of house property, there are certain conditions. First one is assessee must be the owner or deemed owner. The concept of deemed owner will be explained when we come up to reach up to the section 25. Then the property or building must not be used for his own business or profession. If the property is used for his own business and profession, that will be classified as business asset in the books of business, which will be again taxed on the head of PGBP and not on the head of house property. So that is not considered here. And the property consists of any proper physical structure. Next, let us take a scenario here. Mr. Arjun owns a commercial building. He uses the ground floor for his dental clinic and lets out the first floor to the pharmacy. So how taxability works here? Here ground floor is not taxable under section 20. As I said, he is using the floor for his own business and profession, that will be taxed under the head of business and profession. Whereas the first floor which he has rented to the pharmacy, the rental income earned on this rental income earned from this floor will be taxed under the head of house property. Now, I said annual value. How do we determine the annual value of any property? Annual value is determined by taking gross annual value after deducting municipal taxes. So, the formula simply sits as net annual value is equal to gross annual value less municipal taxes. Municipal taxes deduction is allowed when the owner actually pays the municipal taxes. If he does not pay the municipal taxes or the taxes has been paid by the tenant, then the assessee cannot claim the deduction of taxes paid. Earlier in the formula, it was net annual value, which is gross annual value less municipal taxes. So, what is gross annual value? Gross annual value is, here we take up two terms, that is expected rent and actual rent. What is expected rent? The higher of municipal value or fair rent, which are being all these valuation terms happens as per the municipal corporation. So, municipal value or fair rent, whichever is higher, is known as expected rent. When expected rent compared with the actual rent received, which one is the higher is the gross annual value. So, gross now when we know what is gross annual value, after deducting municipal taxes, we reach up to the value of annual rent. Property valuation, as I said, all the this municipal value of fair rent is all valued by the municipal corporation. Next is section 22, deduction of house property. Earlier it was section 24 in the Old Income Tax Act. Here there are two types of deductions that we get from house property. First one is the standard deduction, that is at the rate of 30%, which includes all deductions for all repairs and maintenance. No any further repairs or any separate deduction for repairs and maintenance will be given. A standard 30% is given regardless of the actual expenditure. Next is the interest on the capital. When usually we construct any property or acquire any property, most of the time we take up the loan. After taking up the loan, we have to pay the interest for that loan. So, interest becomes a kind of an expense to us. So, deduction of the interest is also allowed. But interest deduction is like we have differentiation. If the property is self-occupied property, that the assessee itself is using the property, then the interest deduction is maximum up to 2 lakh. Why? Because for self-occupied property, annual value is nil. So there is no income from such property, and we are giving the deduction. If whole actual rent is given as deduction, it would become a loss to the government, because having nil annual value of a self-occupied property and giving whole actual rent as deduction would come up to a negative house property income, which when clubbed with all other heads of income would bring down the total income, reducing the taxes which we pay on the income. So, interest on the self-occupied properties deduction is limited up to 2 lakh. Next, when we for the letter of property, actual rent is given as deduction. Why? Because here the income is earned. So, as like basic rule, if we say when any income is getting where any property is income generating asset and any expenses incurred for that, all the expenses will be given as deduction. And here also there is the limit of pre-construction interest. If in this current year my building gets constructed or I acquire in this year, if I have taken 2 years before, 2 years prior a loan for constructing that building, the interest which you have paid before the property getting completed, or we term it as pre-construction interest. So the deduction of pre-construction interest will be given into 5 equal installments, starting from the year in which the construction is completed.
What is the construction period?
Construction 5 years. Like 5 years.
It is not constructed within 5 years.
Like it is, we have after post-construction, actual interest is given as deduction.
There is a condition. Construction should be completed within 5 years, then only we will get the deduction of 2 lakhs. If it is not constructed within
For this.
5 years, then what is the amount? What is the quantum of available?
For self-occupied properties is 2 lakh, and for letter of properties it is
That is
actual.
only if it is constructed, is completed within a 5 years, we will get a 2 lakh deductions. If it is not completed within 5 years, then how much will we get?
If it is not done.
We will get 30,000 as a deduction.
Yes, in other cases it is 30,000. As I said, 5 installment rule. If interest is paid prior to the year of completion, it is deductible into 5 equal installments, starting from the year of the completion. So if the construction ends in November 2025, total interest up to that year, that is 31st March 2025, is allowed in the 5 parts starting from the year 2025-26. Next, section 23 is of rent, arrears and return. Here, if any rent which we receive in arrears or unrealized rent in the later years, like the rent was accrued in the earlier years but was paid in the current tax year, then we calculate we take it as an income in the year in which it has been received. Here, ownership status at the time of the receipt is irrelevant. If any person, suppose he has sold the property to somebody else, but now he receives the arrears and rent, still that income gets taxed under his hand. Also, 30% standard deduction is allowed. So, if Miss Priya sold her apartment in 2024, in 2025, her old tenant paid 1 lakh as past due rent arrears. So, what happens here? The rent amount which she has got in the year 2025, it will be taxable even though she is no longer the owner. And the taxable amount will be 70,000, that is 1 lakh, reducing 30% deduction. Section 24, property co-owners. Here, when a property is owned by two co-owners, it won't be with definite and certainable share, like the ratio in which the income will be divided is identifiable. Then in such cases, the property will not be, like income will not be assessed as an association of persons. Rather, it would be added in the individual total incomes of the individual persons. And in case of self-occupied property, each co-owner will get the deduction of 2 lakh rupees. As I said earlier, that the assessee must be the owner or deemed owner of the property for that topic, for that income to be considered in the house property income. So, what does deemed ownership mean? If any assessee transfers the property to his spouse without any adequate consideration, even though it has been transferred in the name of the spouse, still the assessee will be the deemed owner. Similarly, if he transfers to the minor child in the name of minor child, he remains the deemed owner. And in case of impartial estate is, for example, you can say ancestor property. That if it is not properly divided in all the successors, if it is not possible to do that, the property remains in the hand of the eldest son in most of the cases. So who holds the property becomes the deemed owner of the property. And allottee in case of member of housing society. In a member of housing society, how does that work is, all the members have their own flats, but in paper the ownership is of housing society or company. So if we look into properly the legal language, who is the owner, then all the individuals who own the flat and earn rental income on that would not be taxed. So in that case, even the allottee who owns the flat, not legally in paper, but then also he is termed as deemed owner. Here, after section 25 gets completed, the section head of house property income gets completed. Now we take a step into the another head of income, that is profits and gains of business and profession. Section 26, basis of charge. As I said before, basis of charge is nothing but a legal authority given to collect tax on or any income to be taken under the head of PGBP. So any income earned from profits or any business or profession carried on, or any compensation for agency termination, then benefits or perquisites arising from the business, export incentives or duty drawbacks, and many such line of income are included in the heads of PGBP. If we take up into a case, a software consultant receives a luxury car from a client as expressing gratitude for the successful project completion. What happens here is the value of car is taxable under section 26 as a perquisite arising from the exercise of the profession. So even though the car is received, that would be taxable in the head of PG. Section 27 is computation. Here section 27 says that all the provisions contained from section 28 to section 30, except for section 58, which is presumptive basis taxation. Except for that, all the provisions says how do we calculate the income from PGBP. Rent, rates and repairs, section 28. What does this section say is all the expenses or expenses related to premises like rent, rates, taxes or insurance on the premium are allowed as an expenditure. Then current repairs, any current repairs to the building, machinery are allowed as a deduction from the income. Also insurance, any insurance premium from stock in trade or any transit insurance are allowed as an expenditure. Here, current repair, there comes two types. We have revenue expenditure and capital expenditure. What does revenue expenditure mean? It is like painting or changing any worn out parts of the machinery or any periodic maintenance that doesn't change the doesn't increase the age of the asset. Such expenditure is known as revenue expenditure. So revenue expenditure are allowed as an expenditure, but rather capital expenditure like adding a new floor or adding the life of the asset are not allowed as deduction. So as I said, under the new act, current effect strictly implies the preservation of existing utility and not increasing the value of the asset. Any expenditure that increases the value of asset is not allowed as deduction. Section 29. Section 29 says that any expenditure incurred for the employee welfare, such as contribution to provident fund, gratuity, then expenditure on technical training, staff welfare and medical facilities, all such expenditure will be allowed as a deduction. But in case of provident fund, if you pay the provident fund within the statutory due date, deduction will be allowed. But if you pay it after the due date, it would rather be included as an income in the book, calculating the income. So if we take an example, if the company deposits the employee's PF contribution 5 days after the statutory due date, what happens is under section 29, the deduction is permanently lost as the payment of employee share is treated as income and not allowed as deduction. Then comes section 30, certain premiums. Like if you pay premiums in case of stock in trade or health insurance of any employees, keyman insurance. Keyman insurance is nothing but insurance which we take for the any person who is valuable to the company or whose loss might affect the running of the company. Such person is termed as keyman, and any insurance taken for such person is also allowed as deduction. So if you take an example, a tech startup takes a policy for its head architect to cover the business loss in case of his demise. So what happens? The premium is fully deductible as business expenditure under section 30. Any sum received is taxable back as business income. Here's a quick reference of what were the old sections and what are the new sections. As I said, house properties basis of charge section was 22, which is now 20. HP deductions were under section 24 priorly, are now in section 22. Then PGBP basis of charge, which was earlier in section 28, now it is in section 26. And business repairs, all the deductions which I mentioned earlier, was in section 30, now is quoted under section 28. And as we all know that in the new Income Tax Act, everything is being getting digitalized. So all the sections from this Income Tax Act are linked with AIS, that is Annual Information Statement, and DIS, Taxpayers Information System, to help SECs easily file their returns and minimizing errors which priorly used to happen if you do it manually. Also checking it triangular way and matching it so that there is no evasion of any tax. What is the vision of 2025 beyond? It is transition to like all these sections, not just 20 to 30 of Income Tax Act, makes a shift from enforcement to facilitation by simplifying basis of charge and rationalizing deductions. Also, India moves closer to frictionless tax regime. Taxing smarter, growing faster. Simplifying the law, strengthening the nation. Thank you.